Thank you for the reminder on the recording. Online Trading Academy professional staff and the employees are not recommending, advocating, or soliciting the buying, selling, or holding of any investment, the use of any investment choice methodology, the use of any particular trading platform, or the use of a particular broker-dealer. Trading and investing always involves high levels of risk. Any money that's allocated to trading and investing can be lost in its entirety at any time. You alone are the person responsible for trading and investing activities that you undertake. Demonstrations of trading processes, including but not limited to the choices of investments and making a trade that are presented during this training, are not a representation or any prediction that any account will or is likely to achieve the same profits or losses similar to those discussed or shown as part of the demonstration or as part of our training. Instructors may from time to time express their own personal opinions. However, we're not authorized nor do we assume any responsibility for your actions. Future results can be dramatically different from the possibilities that are presented in training. Past performance does not guarantee future results. Your participation in this training constitutes an acceptance of all of the above. Remember that all this material, all content is presented to you as part of Online Trading Academy's ownership and copyright laws. It cannot be redistributed, reproduced in any form without any prior written consent of Online Trading Academy. Okay. Lee says, when did you stop recommending brokers, trades, and taking responsibilities for my trade? Haha. Okay. So yeah, again, you all are just assuming all the responsibilities, and this is just one of the technicalities of the things that we have to do every day. So with that being said, let's go ahead and take a look at some charts. There have been a couple of things that I've seen that I feel would be beneficial to point out today. So I'm application sharing my TradeStation with you now. Hopefully you all can see my charts. All right, go ahead with a green check mark, just making sure that everybody can see this. I'm actually in the Irvine office today. We had an all-star event yesterday, and we have another one tomorrow, so I'm actually doing this live from the Irvine office, and I'm using my laptop, so that's why I'm just verifying that everything still looks okay. All right. So what we have here, first trading opportunity that I wanted to point out, I'm going to go into the index futures as well as the financials and some of the others, but I kind of want to point out a couple of opportunities that I see presenting themselves now, and so I'm going to go ahead with those first. The last chart that I just got done looking at was corn, and while I don't know that this market is going to hold off in a shorter term time frame as a swing trade, something that we might want to be looking at here is this level that we're coming down into on the corn. And on the 60-minute chart, looks like this level from November 8th having a low that is in there. Just one second, let me get rid of this line. And the level that I see that's being put in over here down at this 380 level, the area that the market is more than likely coming back to is probably down into the extreme low level. But if this particular 380 area does not have the capability of failing right at the level that we're coming into, it might have a little bit of a bounce off of it and the potential to continue to go higher. Obviously, we would prefer to get in even a little bit lower down at the bottom. So that's exactly what I would prefer to see. When we go to the bigger time frame, when we look at it on the daily chart, you can see that the low that I'm talking about down here at this 375 would be even better than the 380. So that's one of the things that I wanted to point out with on the corn. If that 370 area, 375 level gets broken, I wouldn't want to have any part of this, because you can obviously see that there's much lower levels that the market could break down to. So if you get into a trade with very low risk coming into that level, then that's something that you can look for. If you get stopped out of it, you'll be happy because the market has even further propensity for it to go much lower than that. So depending on your odds enhancers and how you can score this out, if there's enough reward to the risk and the big picture outlook seems to be enough for you to get into this trade, that could be an opportunity. It's definitely not the best one out there that I found for today. So just one example of something that I've looked at. One trade that I do want to really point out, and it's happening, coming into a level right now that I think is pretty valuable, is going to be this continuous contract on our crude oil. And so I'm pointing this level out. You can see that on the 60-minute chart. On the 60-minute chart from 11:27, we're coming right down into a low level that was being put in on the 60-minute chart, and it's retesting that level right into that area right now. And so to me, it seems like this level seems like it's a fairly decent area. I want to look at it in a bigger picture concept and just see, is this area something that would be worth considering as I'm coming in here and thinking about this as a swing trade. When I look at this, I see that from the time that crude oil was coming up into the $75 range, it was bounced off of it, came back up into it, and then it penetrated through that level and continued higher and created new highs. So one of the things that I'll be looking for is to watch to see this area as it has this pullback down. I would prefer to get into the trade much lower, down at the 65 area. Again, I never know, are we going to have a bounce on a retracement off of the area that we broke out of, or are we going to come back and retest the level of where the lows are at? Jeff Cronenberg says, I bought the ES this morning at 10.89. I've been trying to hold it until the market puts in a lower low today with the target of the gap fill. Is that realistic today? I'll take a look at that, Jeff, but for the time being, if you want to just hold off on that question and remind me when we get into that market, then I'll take a look at it. So as I'm looking at this with crude oil, again, I get this question in emails a lot, and I can only tell you personally what I've seen happen, what seems to work good for me when I'm looking at retracements and pullback areas. The two trades that I see happening on a pretty frequent basis on a pullback are the pullback will retrace back into an area from which it broke out of. From the time that it started going down and then it broke out of this extreme area up here, it continued to go higher. Now, I know some of you might question, well, why wouldn't I go all the way back to the highs that were created in June? And I'm not saying that that wouldn't be something that would be an even further breakout level. But from the time that the market put in this extreme high of the 75 level, failed, and once it broke out of that area, that to me is the most recent price level where I would expect the market to go back to. So if I were looking at this area, I'm looking at the market on a pullback, I would never want to just assume that this is going to get me into a trade at this extreme high. I would want to be watching price action as the market comes back down into this level, and then looking for some kind of confirmation on the things that we already talked about. Holding and basing on an area, coming back into that level, some kind of a drop base, and then a potential rally. And the thing that I like about this on the daily is that after this area was retested, we created this low of 72.39. Now we're coming back into that area. To me, this is a pretty low risk trade, and if the market has the capability of bouncing off of this area, I would be looking for my position, for a much longer term hold of this trade, looking for it to go back up and retest into these highs. That's just me personally, not saying that that's going to work. If you're swing trading it and you're looking at this area, you can see that we've come right down into a nice level. From the time that it put in this low, it spent very little time on this movement at this price level, and then it quickly moved away from it and has fallen right back down into this area. The arrival isn't as fast as when we're going over the odds enhancers. It wasn't as quick as what it could have been to come back in to retest this level and then bounce off of it. So maybe your arrival right now into it isn't a 1. But if the rest of your odds enhancers are there for it, big picture outlook, what's happening with the overall trend in crude, we do have a decent run up in it. And if this does have the capability of bouncing, we could even go higher. And so Sabit says this consolidation worries me around this area. Well, that's okay. If that's something that makes you not want to take the trade, that's all right. I'm just pointing out levels that I see happening. I can tell you that this seems to be a pretty big, large imbalance area with buyers and sellers at the time that the price level was put in. And for me, I'd be willing to put on the trade with knowing that if I get stopped out of it, there's even further levels that it could go down into, which would be an even better buying opportunity all the way back down into that $65 to $68 range that I mentioned earlier. So if you can't take this trade, based on this low holding, and if that's not good enough for you and you want to wait, that's totally acceptable, and that's why we have to know what our plan is before we ever get into a trade. So that to me seems like a pretty decent opportunity as a swing trade, position trade opportunity. One of them, I like that way better than I like the corn setup that we were looking at earlier. When I look at GC, this is the continuous contract on the gold. Something similar with this one is that I see that we had rally down, drop down into this area where we'd spent very little time retesting it. Obviously, it's going to have to fail through these lows in order for me to have confirmation that the market is going lower. So the retracement score would have been much better if we could have gotten into this trade on the 6th of the month. But because we didn't have that opportunity right now, we still would have the capabilities of getting into it and knowing that there is even that the retracements have been tested once. If I'm not comfortable with it, I just would not take that trade. But the thing that I like about it is that I'm looking at this. We do have this nice, great, big, long candle showing me a pretty decent imbalance in price, and that low of 1131.70. To me, if this level is unable to be broken, and the market has the inability to break down from here, I'm still a willing buyer. This has just simply been a pullback. If I get stopped out of it, I'm wrong in the trade, and I can obviously see that there's much lower levels that the market has the capability of going back to. When I look at this, I would prefer to have been in the trade on this GC all the way back down at the lows of 1028.50 and coming back up into this area of 1050 area. So that's where I would prefer to be into it. That's not the opportunity as a swing trade right now. And if you don't want to get into this trade near this level because you feel like it's too much risk and it could go much lower, that would be the next area that I would be looking for a pullback to go to. Remember, this breakout area always has the potential of having a bounce off of it, and this low that's right below it makes it an even more valid level if that area has the inability of being broken. So that's gold. Any questions on these two trading opportunities? I personally feel that of the three that we've talked about so far, the CL is by far the best one. And again, I'm looking at the odds enhancers. We're talking about the amount of time that it spends at it, the arrival coming back into it, the retracement, what would be my reward to my risk. I mean, if I get into this trade on GC looking at the reward to risk, and I'm looking at the lows that are being tested down into the 1131.70 area, coming back down into it, I have very little risk for this trading opportunity if it does nothing but goes all the way back up to retest these highs. If I were in multiple contracts and I was a little bit more aggressive with it, I'd likely take off some of my first contracts up at this 1170 area. I wouldn't be greedy expecting that I want to take all of my profits off at 1220. But this area is definitely, by far, once 1170 breaks, that's going to be a 1210, 1220 is going to be the next level that I would be looking at taking profits off as well. Anthony Bray says, please check natural gas. Well, it's interesting that you said that because at NG is my next pick. All right. And one of the things that you can see on my charts here, looking at natural gas on a 60-minute chart, you can see the reason why Anthony wanted to take a look at this is we're coming up on the 60-minute chart, coming up into a level where we had a high that was being put in on the 60-minute chart, having never retested that level. Seems like a pretty decent move away from it, and quickly coming back up into that area, that if this short opportunity does potentially pan out, could go all the way back down into this $4.50 range and maybe even lower. When we look at it on the big picture outlook, one of the things that I do want to mention is that if we do fail out of this extreme high, we've bounced right off of a demand level, and that breakout level would say that there's probably an even higher possibility of us going back up into 650. So please, for those of you that are looking at this trade, do not be married to the thought that this thing is just automatically going to give you a great shorting opportunity, because we did come right back into a demand level, Again, if it meets within your risk parameters and it's in your risk management to take this trade, then you can go ahead and do that. So, looked at natural gas, looked at corn, looked at crude oil, I've looked at gold. Have a little bit of a cold here, so sorry about that. Let me just take a quick drink. I had a chance of talking with Sam Seiden right before I came in here, and he did say that the last time that he had done a class that you all had taken a look at sugar, so he wanted me to bring that up, and I'm just going to go ahead and do that now. Here's the sugar trade, and I wasn't in the room and I wasn't in the class, and so I'm assuming, I do not know this for a fact, if for those of you that were in there when he was talking about this, I'm looking at this level of 2360, going back in time and looking at it and saying here was probably the potential trade that he was talking about, was coming back up into this 2360 level, and it has bounced nicely off of that area, trying to come back down into this level. You can see that gap up, the gap down, and there's a huge imbalance in price at this level. And so I'm going to be very, very watchful on the sugar contract to watch and see what happens down at this 2140 level, the 2180 area on this pullback down. I don't know if any of you can comment on whether this is what you were all looking at in the room, but I'm assuming that looking at the charts and knowing what we talk about often in the room, that's probably the trade that you all have looked at. Still would be holding on to it if you are short, looking for that low on that 20 to 2140, 60 level that we were just talking about. So, moving forward with that, I also want to take a look at feeder cattle at FC. Okay. And looking at feeder cattle on the 60-minute chart, I'm looking at this. We had a huge drop in price. We've had a drop in the price down into this level. On feeder cattle price, I'm looking at the low that has been put in down at 91.72. We tried to come back down into that 91.72 level, but I've never actually penetrated down into that low, and so had a little bit of a bounce off of it and are now coming right back down into that area. This has potential of creating a bounce off of it, but if this area does fail, we can go in and look at it on the bigger picture, looking at it on the daily, and identifying are there any other areas that the market could go to if this level breaks. And so beyond just looking at it the daily, I would want to go look at it on the weekly. Okay, and the reason that I'm pointing this out is I still think that this trading opportunity has a lot of potential. When we go to the weekly charts and we see the lows that have been put in, the market has the capability of coming back into this area and this range and creating a bounce off the first time. This is a perfect example of those screen doors, the strengths of the doors that we talk about. We're on the weekly chart here, and this is an even stronger door than the 60 and the daily. So if you're willing to put on a trade coming into this level, knowing that you're wrong, below the lows of 89.37 on feeder cattle, may still end up being a pretty decent trade. Just making sure that everybody can still hear me. Okay, yeah, it's a much better trading opportunity for holding on to it. Okay, good. I just haven't seen a whole lot of comments and making sure that I'm not losing anyone in the process of doing this. So, okay, with that said, let's go ahead and take a look at the 10-year. I want to take a look at the 10-year note. I looked at this also today. Came into this area. And this is what I was watching for this morning. It's another reason that I wanted to point this level out. Again, I do not know if this is going to hold, but one of the things that I've seen with the 10-year is that up on the 4th, we had the high of 118.29, penetrated through that level a little bit higher this morning, and have not been able to continue to follow through with that movement. There was a huge drop in price, a small base, and a rally right back up into that level on the 60-minute chart. If this area holds, has a pretty decent profit objective, the speed of the movement back up and the arrival into this area is pretty decent. And the movement away from it and the drop And the fierceness of the move away from it once that movement occurred was pretty decent. So if you get stopped out in it, you know, you're saying, okay, well, it was a fairly low risk trade. I was willing to put on the trade at this level, and if it doesn't work, okay. This is bigger picture weekly. Let's go back down to our daily, because we want to look at the 60 and the daily as well. Now, one thing that I would be cautious of is that if that high does get broken out, again, reminder that we've had a slight pullback here. If we continue with higher highs and higher lows, then that is not conducive to being short in the market. But again, just on that 60-minute time frame, that level seems to be holding, and if that 119 area does not have the ability of breaking with any kind of volume, you would still have potential to go back to retest the lows of 117.18. If that's enough reward for risk in the trade for you and you're willing to get into it, then you can take it. And again, this probably is only going to take a couple of days to pan out, where some of these other trades might take a few weeks or even a little bit longer. Okay. Is the tradable contract, is that TYZ09. I always just go up here whenever I'm looking for the symbol lookup and I'm looking at the contracts to trade. I go to the futures, and then if I'm looking for a specific contract, I go type in 10-year, and then I look to see what it is. And here it doesn't say 10 years, that says data request failed, probably because I'm looking under futures and there's a specific tab for bonds. So now I might do better looking at 10-year here and finding some information. But I believe, to answer your question, the answer is yes on that. But I was just wanting to point out with you which contract it is that you're, the way that you can look up the future symbols and some of the other contracts as well. Lee says the March contract has a lot more volume than the December, and we're going to spend a great amount of time talking about that as we start moving over into the after we have a break here, because we are coming into December rollover contract months, moving into the new contract, which is going to be March, and a lot of the contracts are going to be starting to roll over on Thursday. Today's Tuesday, so you're going to start to see a lot of the volume shifting from this December contracts moving over into the March contracts. And when that happens, we want to be trading the contract that has the most volume. Okay? So we're going to spend some time talking about that. I always like when it gets time to come into the contract rollover and the contract expiration to spend a little bit of time talking about that. And Steve just posted it. 10-year H10 is the March contract, TYH10, excuse me, and TYZ09 is going to be the December contract. Okay. Something else I wanted to take a look at was FGBL and FGBM, okay? And the same way that we like to look at the index futures and kind of see some correlation in what we're looking for and looking at the areas, we kind of look at the other bond markets to kind of help us if we are going to be taking a 10-year note trade, looking at a shorting opportunity. And I believe Philippe Mathis is the one that kind of has been pointing some things out in the futures room, and he's been saying that FGBL and FGBM have been the stronger markets while the 10 years been the weaker markets. And so one of the things that I wanted to look at today was just to see if we did think about taking this 10-year note trade, what's going on with the other bond markets as well. And so I'm looking at this on the FGBL, and I come into the 60-minute chart, I come up to the extreme highs on this area, and I just wrap around some lines on the highs and the lows of this level that was created. And I see that we've come right now today right back up into this area on the 60-minute chart, into yesterday and today, and I'm looking at what the potentials are. Well, the 10 years already looking like we have some possibilities of failing. FGBL is also coming into an area that looks like it could potentially be failing. And again here, unless FGBL can break out of its highs on this bigger picture time frame on the daily, I still think that trading the 10-year, which is the weaker of the two markets right now, would not be a bad shorting opportunity as long as we were not breaking out of the extreme highs. So this is how I'll combine some of the information. Okay. David Kroger says, I've never traded commodities. Do you trade them the same as stocks? the answer to that question is they are extremely different. The volume is different. The trading hours are different. The personality of them is much different. Commodity trading is much more on a longer-term time frame basis. You're probably not going to be intraday trading them, or if you do, you might have a lot more of a difficult time. So if you're not familiar with trading commodities, David, no, it's not the same as stocks. Okay, and so one of the things that you want to pay attention to is that before you ever put any of your own money at risk, any of your own hard-earned dollars, you practice it, you learn the personality of the market that you're going to be trading the instrument, and then you actually go out there and place trades on it to make a living. But we still are looking at the exact same things in every one of these markets, whichever instrument it is in the futures markets that we're trading. We're still always looking for where are the biggest imbalances of supply and demand. We're still talking about rally-based drops. We're still looking at the odds enhancers and using it the same way. There is a 2-day course on commodities that you can take for if you are interested in that, and that would potentially be something that may be of interest for you too, David. All right, let's move on into some of the others that are out there for trading possibilities. I wanted to take a look at cocoa. Okay, looking at this on a 60-minute chart as well. I'm just going to spread this out a little bit so that you can see it a little bit easier. Whoops, I've accidentally decreased it rather than increased it. One of the things that I see that's happening here on the cocoa trade is that we have come back up into an area that we previously talked about cocoa quite some time ago and rallied up into this area. Now on this small little pullback coming up into it, if we still have the inability for us to continue to break out of these highs, it still seems to me that cocoa is still very much working to our favor on that short entry that we were looking at. And so if it still gives me an opportunity to get into it, because the highs that we were talking about on the daily chart in previous classes, and I just wanted to point this out again, is the market has come right back up into that area on that cocoa trade and has never been able to break out of those extreme highs. And I don't know if it was Wiley Jones or if it was Philippe or which one of the students it was that sent me that, but again, still watching it, keeping an eye out on that trade the same way that Sam wanted us to kind of take a look at the sugar trade. Michelle, can you talk about how do you enter a trade? Do you set it and forget it with a limit order, or do you wait for the price to consolidate and enter on a confirmation? That's a very good question, Beth. The way that I do it, and it is very much different if I'm swing trading and position trading versus if I'm day trading. And so because this class is more on swing trading and position trading, I do a lot more of the set it and forget it. And the reason is because I'm looking at the extreme levels of the highs and the lows to have that first retest into it. And it's pretty easy for me to just quickly move through my daily and my 60-minute charts and identify the extreme levels that are out there. When I'm day trading, I will wait to put in a limit order, and I will do exactly what you're mentioning. Is if I'm coming into an area, I may be a little bit more cautious about just putting in the limit order and wait for some other kind of confirmation. In your example, you're talking about consolidation. Yeah, if I was looking at a 5-minute chart and it was coming into a level that I was interested in getting into, I may watch for a couple of bars of basing, and then if the market does have the inability to continue to break out of its highs or break below its lows, then I would enter the trade. And so that's just me personally. Something that I've gotten a lot more comfortable with in the past few months, year, is that I've actually started to even get into a little bit more of a comfort level with putting limit orders out there on even some of my day trades based on the extreme highs and lows of a daily level. So I won't put out limit orders on my Globex highs and lows as much, or my intraday day session only highs and lows, but I will still watch it, especially if I see some other confirmation that maybe it's a big expanded range candle. There's then the arrival down at that level has been very quick with a big imbalance in prices. So it's not just any one thing, and that's That's the art of trading. That's where the skill of it all comes in. So how do I put my trades on? To answer that into a little bit more detail, when I wrap around lines around a level, if I'm putting it around this low level and this is my extreme high, anything that goes above this high is where my stop is. Now, I like to learn the personality of the market, the instrument that I'm trading, to decipher what an acceptable range is, because I hate putting it just one tick or one little point value up above it and then getting stopped out. So I won't put it exactly right above it. I'll give it a little bit of wiggle room in case if it has a fake out of that breakout that we talk about so often. But these two areas, these two lines that are put in here, this is where my entry takes place. Now, you have a couple of choices in your entries. You can enter into the trade with all of your position in at one price level. And you may say that that price level is down at this first line, and that's acceptable. You can do that. Some other things that you may want to consider are scaling into the position. Maybe you want to sell some at this lower line, and then as it penetrates deeper into this level, sell a little bit more, and maybe even a little bit before the high gets put in, and all of it getting stopped out above that area. So I can't tell you what is going to be the best way for you, but I can tell you that I personally have a lot of tendencies of taking trades and scaling into my position. I'll get into a small part of it at this lower level and then add to it and add to it, because anywhere in this level is acceptable entry. I've already pointed that out. I'm not changing the rules. I'm not cost averaging. I'm just getting into the trade with even less risk if I get in here versus down at the low, and even less than that up at this area rather than down in the middle. So my entry is always going to be between the two lines that I have put in there. My stop is always going to be in the supply level above the high and in the demand level below the low. And my profit objectives, all going to be based upon, my profit objectives are all going to be based upon whether or not I'm a day trader, a swing trader, or a position trader. On my day trades, I have a tendency of looking at what was yesterday's close, what was the Globex low, and what was the previous day's low if I'm looking at being short. Okay, that's where some of the areas that I would take a profit off on. If I'm a swing trader, I have the tendency of going back to the last point where the market had a turn. And so in this particular example, we pulled back down into the low of this 330 range, and then we bounced up, but we have not gone up above that high yet. And so I would feel that maybe one of the first potential areas I would want to take profits off is here. But bigger picture, I would only take off some of it here, some of it at the next level, and then potentially all of it at this demand area where I would expect buying to come in. So hopefully that was a little bit of a better explanation in setting your stops, entries, and targets. If I were position trading this, I would be selling up at the highs and holding on for it all the way back down to the lows. So I wouldn't probably be scaling out of this at all if I were looking at it just as a longer term trade. Okay? You're welcome, Beth. Tim Shaker says check out gold. So let's go back to our @GC. Okay? We took a look at this earlier, and let's just go into a smaller time frame and take a look at what's happening. Okay, it is coming right down into that level that we were talking about. And so again, I do not know if this trade is going to work out. What I do know is that if I have enough profit potential, enough reward for my risk, then, oh yeah, Mike Peterson, I take swing trades. If there's enough profit objective for me, and looking at the ability for it to have a bounce off of this level, if I'm a willing trader at this level as a swing trade, could I make money from this 1131 area back up into that 1220 area that we spoke of? Okay, if it fails, I have very little risk. If my odds enhancers are not there and it doesn't work out and I don't want to take the trade, I say pass. There's always going to be another opportunity out there. Okay. Now, some of the others that I wanted to take a look at, I know I looked at corn and feeder cattle, live cattle. I don't believe I did the live cattle chart. All right, so I want to take a look at that one. Okay, 60-minute chart on live cattle. Looking at this, I know Wiley and a few of you have been looking at this as well, and we've all kind of been watching for some kind of a stopping point at this downward movement. What I see with live cattle is that we had a long drop. We started to have a little bit of a base. We're coming right back down into this area on the low that was put in a few days back. And so again, for those of you that are willing, you just wrap your lines around the extreme lows. And then I like to wrap my line above the high off of that candle that the extreme low is placed into. And here becomes a buying opportunity as it's pulling back down into this low level on live cattle. Now when we look at it on the daily chart, okay, this low having been put in, there hasn't been a whole lot of basing with it yet, and what I would like to see on this is that we have the inability to shove below these lows, and then we have a pretty decent bounce off of it. So if you are willing to get into this trade based off of that area being first time being retested on a very short-term time frame, and it fits within your risk parameters, you can take that as well. Let's take a look at it on the weekly. Okay. The weekly chart hasn't given us the confirmation that this is for surely the lows, and maybe would give you a hint of a little bit of caution in here. So again, please don't be too aggressive. I'd like to see these lows holding on and the door being created on the weekly chart and the monthly as well, because this market has been going down. But again, if you're only going to be into it for a couple of days to a couple of weeks, then that would be okay. Tim Shaker says, how about oil and natural gas? Maybe you looked at that already. Actually, I did look at natural gas. I did not look at heating oil. I can go back to the natural gas very quickly and just give you an idea of what I was looking at. I want to switch this back from the weekly, though, to the daily. And I'm only going to talk about it very briefly because I've already been here once. So go back to the daily. But again, what I was looking at with natural gas is that we are coming back up on the 60-minute chart. Again, if we're only going to be a swing trader for a couple of days to a couple of weeks, this trade opportunity up at a sell up at this level may work out. The one thing that I cautioned about, though, Tim, was that if this area does get violated above this 520 range, the market has propensity to even go much higher, so don't be married to that as well, okay? All right. Bill Cruz is asking me if I'll take a look at the British pound. Okay, so let's look at BPZON 09, excuse me. Tom W. says, since you don't use trend lines to help define supply and demand, is it because you found it detracted from the pure supply-demand approach? Actually, when I look at a chart, to answer that question, Tom, when I look at a chart, I can see trend. And maybe I don't do enough of a service because I don't draw trend lines, but I'm one of these people that the least amount of stuff that I put on my charts, the better off I can see what's actually happening with price action. And so if I start putting on trend lines and I start putting on supply and demand lines and then I add indicators and different things, I start to get skewed. I have a skewed picture in my mind. And so for me, I just look at BP right now and I can see that it's in a downtrend. Okay, I don't need to draw the trend line. That's just me personally, and until you all feel comfortable with that, it's okay for you to draw the trend lines. But I am absolutely, as you mentioned in the last part of your question, I am purely supply and demand looking at these charts. And you can see it happening over and over again, that with this approach, buy low, sell high, you're going to make more money than any other strategy that's out there. And so, you know, taking breakout trades, I'm not saying that they won't work. Taking other pullbacks and retracements, I'm not saying that it doesn't work, but I'm just pointing out to you that pure supply and demand levels is definitely going to be something that's going to give you some of the best advantages. So going back to this BP, this British pound chart, and again, thanks for bringing this up. I was going to look at this one too. But as we're looking at this area, going into it on a 60-minute chart, all I like to do is just draw my lines around the lows, coming down into that low that has been pointed out on the demand area. Again, I know I don't put my lines in the exact same places that some of the other instructors do. It's just based on my experiences that I like to put my lines and my levels in there based on where the turning points are and where the biggest capabilities are for them to come back to. The British pound has been unable to break down below this low. It's coming back into that area right now. If this is a drop and a base and a potential rally with a bounce off that first retracement into the area, would produce a very decent opportunity. Let's go take a look at it on the daily chart. Okay, let's look and see what is happening with the British pound on the daily. And again, one of the things that I would caution, it doesn't mean I don't take the trade. It's just a cautionary flag. It's like being on the racetrack. When someone has a crash, you have to put the caution flag out. One of the things that I would caution you is that if you do get into this trade, don't be married to it. On the bigger picture time frame on the daily, it actually, if that level gets broken below that low, you can see that it could go all the way back down to 156 and 158 area. Okay, and Bill Cruz is saying that this area has been hit several times. Well, actually, it's been tested into the level. The low has never really been tested all the way down into the low. It's penetrated into the level and had a retracement into it, but the lows have never been violated or even had a little bit of a fake out into that area. So if you're willing to put on that trade, absolutely maybe a potential. When you get stopped out, there's an even better level that's lower. Now, I just want to address a couple of the questions. Bill Cruz is talking about the neckline of the head and shoulders as well. Yep, agreed. Selena says, sorry, Michelle, I missed the first part. Can you tell how do you get the watching list? Oh, all you have to do is this radar screen that I have put up here. This is something that you subscribe to with TradeStation, and if you want to view that, once you've subscribed to it, you just go to your radar screen, and there's actually a shortcut tool for you to be able to look at that. Under the view, you just go to shortcut bar, and then there's this little radar screen. You click on it, and then that's how you can create your own radar screens. But the radar screen is something that you have to pay a little bit of extra money for, and I love this feature to be able to put in all my own little picks and then just link them to my charts and then quickly selecting the instrument that I want to look at and have it bring it up on the chart. So that's how you do that, Selena. Okay, I didn't talk about that. You didn't miss anything with that. Dennis W. says, which style of trading is best? Reward, risk, time demands, day trading, swing trading, or position trading? Okay, please don't send me any hate mails about this. And I'm definitely not going to be trying to offend anybody. Everybody is going to have their own style of trading, and everybody's going to have something that works out for them better. It's going to fit their personality. But if you want me to honestly answer this question, Dennis, and for the rest of you that are in this room, I personally find that day trading offers the most risk. Okay? Swing trading and position trading are definitely going to be those that are going to offer the least amount of risk when it comes to monetary, as far as getting into it at the buy low extremes and the sell high extremes. But with that said, one of the things that you give up in waiting for those extreme levels is that you do not have an opportunity to be into trades on a continuous daily basis. If you're somebody that wants to be in there on an everyday basis, you might not be able to trade every single day. You might have to have patience and discipline. And it definitely is, like what Steve Missick is saying, it definitely depends on which instrument it is that you're trading. Day trading, swing trading, and position trading has a lot of different factors into it. Many people don't have the opportunity to day trade because they are working a full-time job, and so they need to be looking at swing trades. Now, you can make more money by holding on to trades and setting it, forgetting it. But again, you have to have that patience and the discipline of waiting for it. So that's kind of a sticky subject in answering that question, like I said, I don't want to offend anybody. That's just my own personal opinion. That in my experience as a trader, I've always found that position trading and swing trading are going to, by far, force discipline, force patience, and usually the results of that will give me more profit objectives, bigger reward for the risk. But again, many of us are having the interest of getting into trading opportunities on a daily basis, and so therefore I'm not saying that just because you're a day trader that you have more risk, because you can manage that risk as a day trader. And I am a day trader, I am a swing trader, and I am a position trader. You can be all of them. You just have to be able to recognize the risk and the reward and the advantages and disadvantages of each of them. With that said, I can also offer some feedback statistically about the success rate. You know, typically speaking, the hugest failure rate comes from those that are day traders. And I'm not making that up. I'm just telling you that's the statistics of it. So for people that are brand new to it, you know, that is always one of the things that you may want to consider is trying to get into the trading opportunities that offer the highest probabilities for you. All right. Stanley Wonderman says, let me go back up here. Yeah, and Scott Hunt says that Sam says he doesn't care about the time frame, he cares about the levels. If it takes a day, a week, or a month, it just doesn't matter. And that's exactly what I was trying to point out. I'm still a day trader because if that's the opportunity, that's what I do. But anyway, Stanley Winterman says, if you do enough trades on TradeStation for free platform, the radar screen is for free, otherwise it's $60. Okay, thanks for the insight on that, and that's to answer somebody's question that was asking about the radar screen information. David Hoffman says, Michelle, how much attention do you pay to the dollar's strength or weakness? It's something that you can add, David, to your confirmation, so to speak, or your odds enhancers if you need that. I would say that it's a small part of it. It's something that I consider, but do I place all my emphasis on what the dollar is doing based on the trading examples that I have? No, because these are futures markets that are non-correlated, and sometimes even if the market on the dollar is weak, we can still have plenty of decent trading opportunities in some of the other futures markets. Okay, Evan Morissette says, read Sam Seiden's article last week in the lesson from the pros. It does say the pros and the cons of each type. And yeah, I know Sam mentioned that he had put that article out there, so it's definitely something that you can take a look at. All right. With that said, I think that I'm going to go ahead here and take a 10-minute break. We're coming into the bottom of the hour, and then I'm going to get started with the last part of the day and going more into some of the index futures and talking a little bit more about contract rollover and contract expiration, which is upon us this week and into next week. And we do see some things happening during that time that you may want to definitely be aware of. If there's any other markets that you want me to take a look at, I know I still want to take a look at a couple of others when we get into some of the currencies in that market as well. So I'm going to take a quick break here, give my voice a little bit of a rest, get a break, put something warm in my throat, and then I'll be back. And we'll start it right at the hour of 2:30. So I'm going to stop the recording and stop the application sharing. Yep, Scott, I'm going to just making sure that you can see them. Go ahead with a green check mark if you can see the charts. No. Okay, just hold on a second. How about that? Can you see them now? Go ahead with a green check mark if you can. Perfect. Okay, so let's get back in with our analysis. I wanted to go through and take a look at some of the other markets, as I mentioned right before the break. There was a question that I didn't get a chance to answer, and so I want to do that before I get into some of the other markets. I know that somebody asked a question about setting an alert. Okay, and so when you put in a line on your chart, you can actually right-click on that line, and you can go in there and you can format it. Okay, and so when you're doing that, one of the things that you can do is that you can set an alert. When you format that trend line, you go under the tab that says alerts, and then you can put a check mark under enable alert, and then you can even customize it with certain sounds or a visual pop-up, or setting it, having it come to your email service, and lots of different things that you can do with setting alerts. If you leave that line on your chart, however, and once your order gets filled and you never remove it, anytime that the market comes back up into that price level or down into that price level, that alert will go off. Okay, so for the person that asked about the alerts, hopefully that will answer that question for you. Okay, Evan, you got to run. Go ahead and have a great day, and we'll talk to you again soon. So on EC, this is one of the charts that I was looking at. I wanted to point out, and then looking at that today, I've backed up the charts so that you all would be able to see the low that I'm going to be pointing out on the 60-minute chart that was created back in the beginning of November. As I advance this chart forward into today, you'll be able to see that we're starting to approach coming back down into that level. We haven't completely gotten down in there, but that's exactly what I would be looking at on the Euro continuous contract. And so when I see that, I can see that on the daily chart, from the time that we had this pullback coming down into that level, and again, this was November 3rd, as I mentioned, the beginning of November, this is potentially a great opportunity where the market is going to be having a capability of having a bounce. Imbalance in price, sharp move away from it, went up and retested the highs, and is coming back down. If you get into this trading opportunity, and if it fails below this 146 area, you know that it could even go even lower, back down into much lower levels than that. So that's going to be looking at the euro. I also wanted to look at DX, the dollar. And again, just looking at this chart, letting it bring up the data, you can see that on the 60-minute chart, looks like we're approaching a high that was put in a couple of days ago. And I don't know what's going to end up happening with this, if this high is going to hold. But for the person that asked me how I would approach my trade setups, this is one of those things that if I were a day trader looking at this opportunity and unsure of whether or not to take it, this is the time that the arrival has come back up into a supply area, and the arrival into it has been pretty decent. If it has the inability of breaking through this level with any kind of volume, and I start to see a little bit of basing on a smaller time frame, like a 5-minute or a 15-minute chart, I would definitely put in the order and just watch and see what happens. One of the things that I would also be paying attention, though, in my swing trade is that if this level does get violated with any kind of volume, there's an even better opportunity up at 77.50, 77.75 area. So if you get stopped out in the trade and you're saying to yourself, well, there's a lot of strength on the arrival up to this level, it might continue to go higher, I prefer to be a little bit more conservative and wait for the 77.50 to 77.75 area. Nothing wrong with doing that as well. Dennis says, is basing activity a sign that it won't break through? Basing is a sign of indecision. And while you never know what is going to happen, the very first time that it comes back up into that level, when it has the inability to continue to go back through that level once it revisits it and it starts basing, oftentimes we'll see that drop that we're looking for up into a supply, or a rally that we're looking for up off of the lows. Okay? Jeff Cronenberg says, if we're going to be rolling over shortly, isn't the December contract not a good one to get into now on all the products? Well, these are continuous contracts, and so you can be starting to look over at the March contracts. But for the time being, I would just be looking to see how much volume is in the whichever contract it is that you're trading, whichever instrument. If you see that there's more volume already in the March contract in the market that you're interested in, then go to the March contract. If you still see that there's more activity in trading that's happening in December, then stick with the Decembers. But anything that has an @ sign in front of it is a continuous contract. Okay? Now, Jeff, did that answer that question mark that you had? I just want to make sure that you're okay with that. Okay, perfect. All right, so now let's spend a little bit of time as we can. I'm not saying that there aren't any other opportunities out there, and if anybody wants me to look at another market, we can do that as well. But I'd like to spend a little bit of time now going and diving in a little bit more detail into the contract rollovers and looking at this on the index futures. Many of you that are in here are trading the index futures, and so that's what I'd be watching for. It's why I want to spend a little bit more time in looking at these now as we're talking about the contract rollover and looking at these as swing trades and position trading opportunities. I'm going to look first at the S&P. Okay, and so I'm going to go in here, look at ES. Whoops. At ES. And as I do that, going back and looking at the 60-minute chart and then comparing it to the daily, many of you know that we've been very watchful of what's been happening with the S&P. We just seem to have the inability of breaking through these highs. It just seems like the retracements have been there back and forth over and over again. Some of these levels have been tested 5, 6 times, and yet we still have not been able to break out. Okay, so one of the things that I do in these examples are that's when I start to decrease my contract size. When I see retracements that just have the inability of being able to bust through a level, I don't want to have the belief that it's never going to go up, but I definitely want to know that there's a propensity for it that once it does, the volume is going to step up. So I don't want to keep taking stop outs. But I will still be willing to get into a trade up at the highs, especially when these are up at the highs of the year. Last week, we put in an extreme high on the S&P of 1119 even. And I know many of you were in this room when we were talking about this. What is it that we were talking about that had to happen if the S&P was going to continue to violate through these highs? What was going to have to happen to give us confirmation that this market was going to continue in the direction of the upward trend? Okay, Scott Hunt's answering the question with volume. That's definitely one of the things. But what was another thing that we spent a lot of time talking about last week? As the market was coming up, we needed to see the other markets going up as well. Jeff Cronenberg is absolutely right. The NASDAQ had the inability of breaking out of its highs. The Russell had the inability of breaking out of its highs. While they went up and retested it the very first time, we just did not have the capability of breaking through those areas. Now, it seems like such a minor detail that when you're looking at being an S&P futures trader, that it's like, well, we're breaking out a new highs. It doesn't make any sense to me. How come this market doesn't have the capability of going up? And then you go back and you apply all the information together and you say, these index futures, they have to all be breaking out for me to believe that this overall market is going to continue in this upward direction. How many of you got stopped out in the trade last week when I took the trade up at that 115.50 to 1115.50 to 1117 area with me? I got stopped out just like you did, right? And then we still said, let's watch and see now what's happening as these bigger markets are coming and approaching their highs on the broad markets with the NASDAQ, the Dow. What ended up happening on that particular day? Boom. We got right back into the market. There were some of us that did, some of us that did not. And when you look back at that recording on Friday and you listen to what happened, we called that to the T. We said if we do not have the ability to break out of these highs, then we have a bigger propensity for us to go back down and retest the lows. It was unbelievable to believe that we would have the potential of gaining 20 points in one day all the way from 11.19 back down to 10.99 to 10.95. And some people were not willing to get back into the trading opportunity again because they'd taken a stop out. This is the psychological part of trading, that if you do not have a bias, you will have the ability to get back into the markets and accept the losses and say, okay, bad trade, didn't work out. Not that I did anything wrong, the market wasn't doing it. And so in this particular example, we still have never been able to get back up above 11.19. If we look at a 60-minute chart, we see that high of 11.19. Here's that 11.15, 11.17 area that I was talking about. And ever since that time, now we have started to violate below Friday's lows of 10.95. Where do you think that the market has the strongest capabilities? For those of you that have had the possibility of putting in a swing trade, that couldn't have been another better trading opportunity from Friday. When that market had the inability of breaking through that supply level, and if you could hold on to it for a few days to a few weeks, we said that the first area that it has to go back to give us confirmation that it's going to even go lower is all the way back down to 1067 to 1070 area. And I still haven't been proven wrong in this trade. So anybody that is in a swing trade, I don't know how many of you took it as a day trade and how many of you took it as a swing trade, but if you wanted to start taking off some of your profits and talking about targets along the way, 10.95, Friday's low, was a good place to start taking off some profits. 10.85 is going to be a great level to start taking off some profits. And if you want to be out of all of the position, you could get out of it at this lowest low that has been holding down at that 10.67 level. But if this area breaks, there's way lower numbers even than that, all the way back to the beginning of November. So with that being said, I just want to remind you that I've been getting some emails that are saying to me, Michelle, my data looks different. The numbers that I wrote down yesterday, the high and the low that I wrote down, are different than what they were when I wrote them down last night, now that I'm looking at it today. As this contract starts to roll over, and we start to see the volume moving and more trading going from this December contract, and the way that you'll know that is looking at ES Z09. When you look at that contract, and then you start to look to see where the volume is being traded. Let me go in here and get rid of this. Okay, when you start to look back at the market and you look at what's been happening with the volume, you'll start to see that there's going to be a shift in this volume on this contract of the ESZ09, and you'll start to see the contract volume picking up and coming into the H10 contract, ESH10. So I wanted to spend a little bit of time talking about it. Look at the volume that was on the ESH10 contract up until just very recently. We're starting to see an increase in the volume as early as today. Okay? I can tell you from experience, just so that you all have the information, that a lot of broker-dealers will start to automatically roll over you into the next contract month 8 days before contract expiration, which is the third Friday of this month. So that is the second Thursday of the contract expiration month. So this Thursday is the second Thursday of December, which the contract will start to roll over, and many of the broker-dealers will start to automatically put that in as the contract to be traded. Some brokerage firms require that you do it manually. Others do it for you automatically, and some of them will allow you to trade both contracts, and so you just get to select automatically whichever one that it is that you want. And the way that I do this, and I can only speak for myself, and if Steve Missick or Sam or any of you have heard anything else or had any other conversations about this, I automatically start rolling over with the contract that's going to be the front contract month. So on this Thursday, I'll roll over with the contract rollover and start trading the next contract month. There may still be more volume that's going to be traded in the December contract, but I just like to make it a good practice that I start trading that contract month when it rolls over. Eventually, all the volume will shift into the new contract anyway. But for those of you that are wondering what the difference is, Okay, and again, you may need to go back and listen to this recording. If you type in the ticker symbol at ES, you're just going to get the continuous contract, and it's going to take out all of the gaps that occurred during this last contract and average the prices together. So that's why there's going to be a fluctuation in the price levels in comparison to if you were actually looking at the contract month itself. Okay? The way that I avoid that was through the help of Scott Hunt, who said, hey, you can actually put in the ticker symbol at ES equals 108XN, and it will automatically give you the contract month with the actual prices, and there's no adjustments to it. So when you put in this ticker symbol at ES equals 108XN, this is the unadjusted contracts, and you actually are looking at the prices of the levels with the contract month. You do not have to go back and look at what was happening last year in December. You don't have to go back and look at what was happening in that actual contract month, because this does it automatically by putting it in. Now, this ticker symbol is based upon the assumption that you're going to be using the rollover. You're using the rollover. There is one that will allow you to look at the contract that is when the adjustments are made with volume, when the biggest amounts of volume starts to change over. So depending on which one you want to look at, that ticker symbol is at ES equals 111NN. So the 111NN contract is the volume, and the one that I showed you with the 108XN, that is when it actually rolls over 8 days before the contract expiration. Did I say 111? Okay. Yeah, it's 111. 108XN and 111NN. Okay? All right, so is there any confusion that you have in understanding what's going to happen for you over the next couple of days into the next week? As a beginning futures trader, I found this to be one of the most difficult times for me in trading, because I was looking at numbers, I was looking at values, I'd look at support and resistance, and then I would go back a couple of days later and a level that I had put on a chart wasn't there anymore, and that's because the continuous contract blends those prices together from those gaps and makes it an invalid number. It almost skews the results. So in order for you to be on track with what's happening during these contract rollovers, this is the way that you can do it. In these index futures, you can use those same ticker symbols, whether it's with the NASDAQ, the Dow, the Russell, the S&P. If I have at ES equals 108XN and I want to look at it on the NASDAQ, I can do the exact same thing. It's 11 INN? Okay. Thank you. I just wrote down a 1. All right, so any questions about that? Because I want to start talking about the trading opportunities that I see. Yeah, the I looks like an N, like a 1, excuse me. All right, so let's change that. At ES, 11INN. See, now mine, I just tried to put the at ES 11INN and it didn't come up. At ES equals 11INN. Helps if you put in all of the right details, right, Mark? Okay, thank you. All right, so you can compare the differences in the prices. What I've found is that there's not a big difference, but there is going to be a small fluctuation in the difference between these two contracts, between the 108 and the 11INN. There is going to be a little bit of a variable, but it's going to be the closest thing that you're going to have. And for me, I like to look at what's happening where the price levels are at the areas that I remember. I like to go back if I've got a level that's been written down from a couple of months back and I know that that was a level. I want to be able to see that on my charts, and so I like to look at it on the continuous contract only during the months that we're trading up until it gets into the rollover, and then I want to be looking over. And then another way that this is going to be helpful for you is that when you're entering back into new territories like we are on the daily and the weekly that have been back from '08, we would always have to be going back to looking at the Z08 contract to be finding what the actual prices are, and this just avoids all that confusion. You can just actually look at it on a continuous basis. Okay, so let's go back, look at a 60-minute chart, and then go back to the at ES equals 108 XN. All right, and I'm going to look at it on that level compared to where we are with the daily chart. One of the things that I see as a huge potential for us as a swing trading opportunity is to wait to see what happens down at this 1067 area. Because from the time that the market bounced down into this level, had a lot of weakness, it spent very little time there, and it continued to go back up and put in new highs. One thing we haven't done is broken through that level and had a nice move away from it that I'm going to be looking to see what happens as we come back down into 1067. If I take a trade at this level, I know that if I get stopped out, there's even better levels that are down there. And I can't tell you how excited I will be if we can come back down and retest 1019 area, because this level, once that area was put in, we've never been back to retest that area, and that is going to be a perfect opportunity for me to get into a trade as a swing trade, looking for the market to hold off of these lows. So that 1019.50 area, bouncing off of it, breaking through this resistance area, and coming back to retest it, I will be a willing buyer. All right. Marshall Lee Marker says, the equities, treasuries, and currencies are on the same quarterly schedule, but I have trouble with gold, copper, and heating oil, more frequent contract changes. Yeah, and that's exactly the same with the other commodities as well, Marcia. When you start trading gold and you start looking at corn and wheat and live cattle, a lot of those contracts expire every month or two. Some of them are 6 to 8 contracts a year. So it is definitely the reason why I make mention that you have to learn the personality of the market that you're looking at, and you just can't assume that it's going to be the same as trading any other instrument that you've been looking at. Mike Peterson says, in the range of 1089.79 to 1084.45, it's been visited 4 times, and then broken on 1127. The level was broken, but then reformed later. How strong is that level now? Okay, let's go back and look at it. When we look back at that 1084 to 1089 level on the S&P, and I know that many of you are interested in that area because that's a low that was created as we go back to the end of November. Every single level has the potential of creating a bounce. And because we don't have the crystal ball in front of us, we don't know which one of these areas is going to work. The level that I like better is obviously the 1067 level up into this 1070 area. Would I still be very watchful to see what happens as the market comes back down into this 1084 to 1089 area? That's right where we're at. And if we have the inability of breaking down lower than that 1084 area, we pull back and retrace into it, maybe we don't get through it, would that still be a potential buying opportunity for us as a swing trade for a couple of days to a couple of weeks? Well, if that level holds, bounces off of it, where is the retest going to be at, Mike? Probably all the way back up into the highs up in that 1119 area. If it fails, you take the small stop out and you wait for the 1067 area if that fits within your risk parameters. So how strong is it now? It tested that level once. It's coming back down into it, hasn't been able to get through it. In fact, it might even penetrate a little bit deeper than the 1084 area. It might go down to 1081, 1080, and still have a bounce off of it. There was this big expanded range candle, then a pullback out of that 1080 area when it broke out of it and has never been back into retest that level. And the amount of time that it spent at this area of that 1080 level, once it got up there, it just continued to break. What is the down thumb for, Anita? Can you elaborate? Okay, Marshall Lee Marker says, TP Futures has low trading margins, great customer service, but the rollovers are all manual. Pretty strange until a new trader gets comfortable with it. Thank you. Yeah. So as I'm looking at this as a swing trade, for the person that's asking about that 1084 area, this is still a potential trading opportunity. Obviously speaking, that if we couldn't break through 1119, there's more propensity for this market to go back down to 1067. But every one of these low swing points that were created have just as much of a potential as creating a bounce off of that level as the next area that's out there. This one is just where the last time was that we had a drop, a small base, and a rally on up, and that's going to be the better area of all of them. Could you still take swing trades at some of these other areas? Absolutely. So, better picture, bigger picture, lower risk. I'd rather have the pullback down into that 1067 to 1070 area. Am I a willing buyer at this level? If the market starts to base down into this area at 1084, can't break down, and still has the capability of going all the way back up to 1119? Absolutely. Remember, the more times that it comes up into an area, like this area when we're talking about the snowplow, you all can relate that are in the Midwest and experiencing all that snow right now. You can all relate to having to move snow. Well, after you get a big dump of snow, when you start plowing through it, eventually you're going to clear a pathway. And if we keep coming back up into those highs, eventually, with the inability of breaking through 1067, we have the capabilities of even going higher. Pam Ward says, if it would spike down to 1080, how can you know when to take the buy trade? And again, this is the judgment call that I was talking about earlier. One of the students asked the question, what would be the confirmation? Would you need to see some consolidation, or what would you look for? Because this has been such a big spike and price spent very little time there, I would expect that the 1067 area would be even better. Would I look for the 1080 to 1084 area? Yeah, but I would look on the smaller time frames to see if there's any kind of basing activity that's happening before I would just put in a limit order, Pam. And that's one of those examples of waiting, and that's why sometimes I, maybe not get filled at some trades, opportunities that would have made me money. But because I need a little bit more confirmation, that's what I like to do. Okay, what about the NASDAQ? What's going on with it? And we're going to go in and take a look at NQ equals 108XN, same way, just because we have these contract months that are expiring, coming into the levels. And again, this is a perfect example of what we were talking about from last Friday. We needed, at the time that the S&P was breaking out of its highs of 1117, the NASDAQ was coming up into the previous day's highs and continued even higher on Friday. And the reason it continued higher was because it was going back up to test the 1813.75 level that was still out there. That number had not been retested on a bigger picture time frame like that daily, and so that's exactly what they did. And you can see it perfectly right here. When the market put in these highs, continued to go lower, even gapped lower, then it came back up, filled in that gap, and came right back up into those highs of 1813.75. Now, since that time, has never been able to get any decent volume to follow through with it. What is the area that you would expect if you did take a swing trade, or if you were holding on to this for a little bit longer, the first level that the market would go back to as a NASDAQ trader? All the way back down, potentially, into that 1720 area. May not work, may only come back down into 1750 and then bounce and keep going higher. But again, until that market breaks out of those extreme highs, I'm still willing in this swing trade opportunity to hold on to this and look for a retest down into the lows. Now, one of the other things that I wanted to consider in looking at this, if the market does break out of that 1813.75 level, and this is the reason why I want you to be looking at the 108XN contract, is because when we look at this year and we go back and we look at just the year of 2009, we are into the highs of the entire year. This is the highest high of where the NASDAQ has been. With that being said then, we need to make sure that we go back to the left side of our chart and figure out where our potential supply levels or demand levels that were put in previously before these highs were put in. So we go back and we look at a bigger picture time frame, and we look at, in this example, we can go back to the weekly chart and look to see what happens if that 1813.75 level gets broken. This is a huge area, because if this level does get violated, we still have, according to this NASDAQ, much higher levels, and we could get all the way back up into 2000. Okay, so the NASDAQ is telling us that if this level does not hold, that there's even further propensity for this to go all the way back up after all this big movement on a sharp drop base and a rally. We would expect that the market is going to have, on a bigger picture time frame, a rally back up into these price levels that were created last year at the end of the year. And so when I'm looking at this NASDAQ market, looking at the S&P, when these markets do decide to have a snowplow with some volume coming through these highs that have been put in, this is exactly the level on the NASDAQ, up at this high of 1976 into that $2,000 price and 2000 price range that I would be looking for it to go to. Now, let's look at the Dow. And before I go look at the Dow, I just want to switch back quickly to the S&P, because I didn't take a look at it on the bigger picture time frames to show you where the S&P could break out of and continue higher to. So before I look at the Dow, let's go back to the S&P. And I wanted to look at that as well on the weekly chart. And you can see that if this S&P decides that it's going to break out of these extreme highs up at this 1119 area, we could actually get all the way back up into bigger picture time frames up as high as the 1300 level, 1350 to be exact. Okay? Now, I don't know if that's the exact number that they're going to stop at, but that's where the turn came, and I would be wrapping some lines around that area where I would expect a retest into that area. Okay? Somewhere around that 1300 level. Now, does that mean that it won't stop at each of these bars' previous highs or previous lows? No, you take that into consideration on a shorter term basis. But imagine that you see that breakout occurring and it goes all the way back up into that 1300 level. This is one time where if there's enough reward to risk in your trading opportunities, that you may find it profitable enough to take a breakout trade. Okay, where would you have to put your stop? Below the swing points of where you know that you're wrong. And if that fits within your risk parameters according to what you can make profit-wise, then you can take it. I can tell you though, honestly, I've grown to hate taking those breakout trades with too much risk. For some reason, it just seems that the market has those pullbacks over and over again, and I prefer to take the pullbacks and the retracements rather than the breakouts. That's just me. Okay? So let's go back to the Dow. We said we would take a look at it at YM equals 108XN. Taking a look at this and what the capabilities are again, I want to switch this back over to the daily chart just to show you what I seen last week when we were talking about this. Okay, and the 60-minute chart is coming up. As the S&P was breaking out of its highs, the Dow had put in this high the previous day, and on Friday came right back up to retest these highs, while the NASDAQ was coming up and testing its highs and had the inability of breaking through with any kind of volume and had a sharp drop right back down to the previous day's lows. Since that time, the market has never been able to get back up above these highs in the supply level, and I would expect that the next area for them to come back down into is 10,150. Now somebody might say, well, that level was already tested once. You're absolutely right. It was tested once. So therefore, it may not be as good of a buying opportunity as it was when we seen that level being tested back in the end of November. But that's what I would be expecting to see happening, is that S&P would be coming down into the 1067. The Dow will be coming back down into 10,100 area. And the level that we were looking at on the NASDAQ, we would want to see that area. Let's go back and look at what the low is on that level as well. I don't have that one committed to memory. That one was 1720. Okay. Now, let's take a look at it with the Russell. At TF equals 108XN, and some trading opportunities that might present themselves down the road with this one as well. Here you can see with the Russell, and this was on the 60-minute chart, that the highest high that had been put in for the year for the Russell had been all the way back on 11/16. It was at 605.10. Last week, when the market came into the highs up at that level of that 605.10 area, had the inability of breaking out of that range, and since this time has based and is now starting to drop. We would expect that the Russell would have the capability, if it's unable to break through these highs, of coming all the way back down into 585. Now, day traders might be taking trades at these lows and these highs, looking for the confirmation of the movement. And again, if this market has the inability on all these broad markets of breaking out of these highs, there's more propensity for it to go lower. In fact, if we break down below this 585 area, I wouldn't be at all surprised to see it come back down to 570 and even potentially down into that 560 area. You can see that when the market hit 560, it created a double bottom, and from that time, we've had a very nice rally on up in price. Tom W. says, does the time difference between the low and the retest factor in? Example, 1 week versus 2 months. Well, I actually believe that the time factor does make a difference. The shorter the time period that you're in the trade, the bigger the possibility is that you could be wrong. And the longer that it's been in the retest factor, and I'm making sure that I understand your question right. I think that what you're asking is that do you prefer to see it that there's very little time that it takes to come back into that level versus that it took a lot longer to get back in there? In my opinion, and this is only my opinion, and Steve Missick, if you want to comment on this, you can as well. But the one thing that I think is that it doesn't make a difference to me what time it occurs, how many months, how many hours, or how many weeks it's taken to get there. If that's a valuable level, I'm willing to take it. So I can honestly answer to you that the time between the low and the retest factor does not make a difference to me. All right, Scott Hunt says, anybody take a long on the Bollinger Band and the CCI signal on the 5-minute of the S&P at 1089? Again, that's a day trading question. I'm talking about swing trades in here, so you all can talk about that amongst yourself. All right, Tom, you're welcome, no problem. So PM says, the more times it reaches up to the highs or the lows and does not break through that may mean it is likely to drop down to a lower high. Well, again, PM, you have two possibilities. When the market comes up and it rallies up into a high, and it tests that level, and it tests that level, and it tests that level, and you start to create some basing. And this market has been doing that, especially with the example that we were talking about with the S&P. The more times that it sits there and bases, there's only two results that can happen. And I want to look at a bigger picture time frame. It's either going to be rally base drop, which is the preferred higher probability trade, which in this example, rally base potential drop. That's what we prefer. But there's also that possibility of rally-based rally. And the more times that it comes up into a level, usually the less interested in it that I become, because the belief more times than not is that it's going to have more propensity to go higher. There are times like this that the market just has the inability of breaking out, which still presents plenty of trading opportunities to the short side. Okay? Oh, no, that's okay, Scott. No problem. Don't worry about it. You guys can talk amongst yourself. I'm just going to avoid the questions off of that then. So, looking at the retest, and I'm not sure if that answers your question, Pam, normally what we say is that it normally what we say is that the more times that it tests into the high, the higher the probability is that you're going to get stopped out. Because the more propensity the orders are being filled, the volume goes away, and off of those orders that the imbalance was, that the imbalance on those orders that was there previously, and then eventually you'll see a breakout of that level. Okay? Now, let's go back and I just want to make sure that everybody is okay with understanding this contract rollover, why it is that I'm looking at some of these other charts, because a lot of people are new into the futures markets, and when they look at a chart, they may be used to seeing at ES, they may be used to looking at the actual contract month ES-Z09, and I want to make sure that for those, especially those new people, that this is their very first time experiencing a contract rollover, that you understand why we actually go into a different ticker symbol during this time. Okay? This is extremely important. John O'Donnell, OTA Globalization 3.0, said that this move since March is a bear market rally. Could this be a top of that rally? Well, it most certainly can be, Dennis. And you know, this is where I think that Steve Missick's information that he presents when he's talking about the cycles and the stages and the different moves that happen, and when you start listening to John O'Donnell and some of his information, sometimes that can give us a little better, clearer understanding just on what we're seeing in the charts. And so, Dennis, I would say to you that that could absolutely be right, that this bear market rally that we're seeing is simply a retracement off of that big picture look on the bigger picture time frame off the weekly. If you go back and you look at this chart on the at ES 108XN and you move into some of the bigger picture time frames, you can see exactly what John O'Donnell's talking about. This was a huge drop in price, and there was a big drop, very little base, and a rally that's happened since then. When the market was suffering and all this bad news was coming out, there wasn't a person in the world that would have thought that this market would have bounced off of 665 and would have gone higher. If you were listening to the news, you had so much bearish information. In fact, on the way over here from the hotel this morning, the taxi cab driver had to drop another person off, and I got into the room and somebody said, "Where are you going?" And I told them, and they said, "I can't believe that anybody would be interested in buying the markets now because we've had so much bad news." And that's the mentality out there. Okay? So that's why we just never want to have a belief that the market is going to go into one particular direction. The same way that I don't want to have a bias that this market is going to only go down, I also do not want to have the belief that this upward trend is going to continue to go all the way back up to 1300. I will watch and make the market prove to me that that's what's going to happen. If these levels of 1119 get broken, then yeah, I believe that 1300 level is possible. But if we sit here and base and have the inability of breaking through these levels, and especially once we start breaking through these necklines around that 1000 critical area, we have the potential of going all the way back. And for those of you that have been reading the tape and watching your numbers and keeping track of your numbers this year, there's a very critical number that's sitting out there, and I can tell you it is 885, 880 area. That number is absolutely going to be critical, because since the time that we had that pullback down into that 885 level, 880 area, we've never been back. So if this market has the inability of breaking through 1119 and it breaks through this neckline, that's the area that I would expect them to go back to. Pam Ward said, "It's my understanding correct that you cannot trade the ES equals 108XN, but we use it to look at it because it allows the accurate history." Absolutely. Yeah, you can't trade anything that has an @ sign in front of it, but we're using it so that you have the accurate information instead of just looking at it on the @ sign. Okay? Because when you go back to looking at ES-Z09, how much data do you have here? Okay, let me erase this. Okay, you can only see back a little bit of time. You can't go back to last year and see what's happening. So this will allow you to be able to do that. You can't trade anything that has an @ sign in front of it, but you'll be able to trade your ES December contract or your ES March contract with the accurate numbers, and that's the reason for pointing this out. Michelle, on contract rollover day, do you trade or do you give the market time to adjust? How solid are the levels during this time? Great question, Mike. I absolutely trade. I'm not scared of taking the trade, but it goes back to the examples of the things that I've been talking about. Whenever I get into contract rollover, this is a time that I'm more cautious in the market. A lot of different things happen during this time, and a lot of movement because of volume, contracts being traded out of, and new people entering into other positions. There's a lot of activity. I will typically not sit on the sidelines, but I will reduce my position size. Okay? Any questions about this? Because now I've gone through the Dow, the Russell, the S&P, and the NASDAQ, and I've pretty much explained to you what I'm looking for on these bigger picture outlooks, and even the smaller term next couple of days to couple of weeks of what I want to see on these index futures. Let's go ahead and take a look at FESX. Scott Hunt's asking if we can look at that, and we absolutely can. Okay, let me switch this over from a weekly chart to a daily. Let my 60-minute chart bring up that data. Okay, here's what I see on the FESX. All right, I pretty much am in no man's land right now as getting into a trade at this exact price level, but what I will be looking for is what happens as the market comes back down into this 278, 280 area. And again, because it's been tested a couple of times, I won't just automatically put in a limit order there, and I would be much more willing to be a buyer down as it comes down into the level of the 274. You can see that on that day, the price gapped down, had spent very little time there, and price rallied up real quickly away from that level, and the origin of the move is definitely back down at that 274 area. Absolutely would be a willing buyer into that area based on that information. When I look at it on the daily, you can see that same exact information. You can see that when the pullback came into this area, that 273 level, if this does get stopped out because of this inability to break through the supply level and this stops you out, there are a couple of other swing points that may potentially be areas. But this is going to have to break through this neckline with some pretty decent volume to give me confirmation. And so therefore, I'm always a willing buyer at the low levels with a very small stop out, and then if I'm wrong, I wait until I get a better entry. Okay? Now, a couple of other markets that are out there that I wanted to take a look at. I think FGBM, I talked about FGBL, I didn't talk about FGBM. So just going to take a look at that one as well. This is another financial market. And again, you can do the same thing that you're doing with your S&P trades on those index futures, looking at the S&P, the NASDAQ, the Dow, the Russell. You can also do the same kind of thing with looking at FGBM, FGBL. And again, I said I was going to look at this and I forgot, so I wanted to go back in and look at it. Here it is approaching up into the extreme highs, okay? And we'd want to see what's happening off of this level. Is it going to have the inability on a very small term time basis to come back into testing in these levels and holding off of it? And if it does have that ability, it should have a pretty decent drop in price. But if it violates through this level, we can see that bigger picture, the capabilities are that if we get stopped out, we may go even higher. We're entering into new highs. All right, let's decrease the spacing here and look to see the levels. Okay, One thing I would be watching for on this is just to see where there starts to become some basing and some kind of an indecision in the market. For the time being, until this thing can stall down and base for a little bit, we don't have that confirmation, but it still has not broken through those highs. All right. Any other markets that you want to take a look at? I've pretty much gone through a lot of the stuff that I wanted to share with you today. Japanese yen, sure, let's go ahead and take a look at that one. Just takes my charts a few more minutes on these 60 minutes trying to bring up all that data. Looking at the Japanese yen, one of the things that I can see on this as a swing trading opportunity is that we're coming up into an area that from the time that we had a drop and a base and a further drop, the market is coming back up into this level. This is not the perfect setup, okay? Avocados, that's pretty cute. I think I know where that comment comes from because Sam likes to use avocados for his examples sometimes in some of his presentations. Anyway, looking at this basing activity of what happened, from the time that the market put in this basing activity and failed, big sharp price movements away from it, now has dropped, very little basing, gapped up, and has continued to have a rally back up into this area. For those of you that are willing to get into a trade on this Japanese yen, you would know that if it starts to violate through this resistance area, which we call supply as well, that there would be no longer an interest in being short. But if you're willing seller into this level, taking on that risk, then your expectations would be that it'll have a pullback, at least coming back down into the area of where the turn occurred for a few days to a few weeks to have happen. What does it look like on the daily chart? Okay, and this is actually the weekly, which may be even a little bit more, even a little bit more powerful. When we look at it on the weekly, had a big spike up in price, has had a big expanded range candle with some weakness, showing that the bears were in control last week. What does it look like on the daily chart? So with that gap up, big spike up in price, showing an imbalance. I actually will like this trade even better. I would hope that they would give me the opportunity to come back up into the 116 area so I can get an even better shorting opportunity. That may not happen. Okay? Just a couple of other highlights about some of the things that I've done with this radar screen. The futures markets are really separated into a couple of different instruments, even though they all are futures. What you can see on this radar screen, looking to this left side of my charts, you can see that the first few symbols that I have in here are all the index futures, S&P, NASDAQ, Dow, and the Russell. The next few symbols that I have in here, the TY, the US, FGBL, and FGBM, are all of the bonds or the financial futures markets. As we go down a little bit lower, we start looking at some of the others. We have CL, which is oil, NG, which is natural gas, HO, which is heating oil. And so those are going to be your oil products, or going to be your energy products that are part of the futures market. Then I've gone in and I've separated this into the metal markets. And so you have gold, you have silver, you have copper. Beyond that, then we start to move over into the commodities markets, and the commodities are separated into hards and softs. The hards being the corn, the soybeans, the wheat, the oats. Then you have the meats. You have lean hogs, feeder cattle, pork bellies, live cattle. And then you have the softs. We start looking at cocoa, cotton, coffee, lumber, orange juice. And as you move down into that lower, then you have sugar. Okay, and so these are some of the ways that you can separate your futures markets. When you're going to be a swing trader and you're looking at doing swing trading and position trading, it might not be a bad idea to create some kind of a radar screen similar to this that you can link these charts together, and then it just makes it that much easier for you to do your assessment. I can come in here in less than an hour and go through all of this information. Okay. Joseph Stevens says, Michelle, can't you do the same thing with quotes pages? I'm sure you can, but I'm not sure that they link together everything. So anyway, I just wanted to point out what I was doing here and showing it to you all. So we have sugar. And then we go down into some of the other markets that are in the currencies. And we have the US dollar, the euro market, the Japanese yen, the British pound, the Swiss franc, the Aussie dollar, and the rest of them. Anyway, I kind of just wanted to share with you some of my insights as to things that I was seeing as potential opportunities. I really truly believe that that CL chart, let's go back and take a look at that and see how that trade is working out. If there was any entries, I'm not sure if any of you were able to get in on this trade today. Okay. I know that that was an opportunity that I was really looking forward to seeing if it was going to pan out while we had some time together today. And I don't know if any of you have taken along into this level. Pam Ward says, I can't pull up the commodity charts. Which data feeds do you need to get that information? Yeah, you just go, one of the things that Steve Missick is saying is go to the TradeStation website, and then using the help menu in the TradeStation, you actually have to go in and log into your account management, and then you have to go in and apply to have the ability to see the commodities. It's a separate data feed. It's not included in part of the futures. So you actually have to tell them that you want to be able to see the commodities. And there's a delayed commodities charts, and there's actual live data. I'm not so much worried about having the ability to look at them on an intraday level, because most of the time when you're talking about trading the commodities markets, if you're looking at something that's 20 minutes delayed and you're only going to be looking at trading it on a longer term swing or position trade basis, you don't need the intraday. So it's a small fee for that with the delayed charts. Okay, with that being said, I think that it's been a great day. Hopefully you all have had some good opportunities in identifying some levels and have learned something about what to look for during this contract rollover and the contract expiration as well. Everybody have a great day. Look forward to seeing you all throughout the week. Thanks, everyone. Thanks for your help, Steve, in answering all those questions.